Today, we're taking a look at whether the energy sector is going to make a rapid comeback and what that means for inflation. And then the trade and takeout today is going to be, should you ever copy someone else's trade? We're going to find out exactly what I mean by that. But first, make sure you like this video and subscribe to the channel to let me pop up in your YouTube feed every day, giving you the best market commentary, tips, and tricks so that you can improve your trading edge. So, I've got an oil chart in front of me. And oil's not something that we've spoken about in quite a long time, actually, but I think we're at a really, really key stage, in fact, because if we're looking at, what Bank of America have said in their recent flow show report, we've got it here. It says, in keeping with an anti-cyclical bias, I think LOs is long only, so have a 26% underweight in energy after dropping exposure by 12 percentage points over the last 3 months. Energy exposure has been meaningfully lower only in late 2015 and during COVID. Energy has also seen a notable rise in short interest over the last 3 months, and it is now the most shorted sector. That's terrifying. Meanwhile, geopolitical risk, supply discipline, and nearshoring of US manufacturing pose upside risks to oil prices as it marches towards a breakout. And I've got to agree. I've really got to agree here, because if we're looking at the momentum currently, and this is what I'm massive on with how, not necessarily how volatile, but how bullish we have been in equities and things like that. This is what I'm focused on right now, because if you look, there's the 200 daily moving average, there's the 20 daily, and then there's the 50. Above them all, we just had a recent spike off the 20 and the 200. For me, that is, insanely bullish. And then even if you look at your traditional, I guess, chart patterns, you've got a big cup and handle here. But at the end of the day, when you're looking at momentum, you're looking at reasons for something to increase, and it makes sense. US growth still strong, US consumer relatively still strong, credit card debt is still increasing rapidly, God knows how, and so people are still buying stuff. We have seen a slight slip in some of the data last week in the US. I think it was the PMIs indicating some contraction in construction, which, fine, there is some data that is mixed. But at the end of the day, everything looks to be pointing to the upside with regards to energy. It being the most shorted sector, as it says here, that is a short squeeze potential for oil. You can look at, maybe, if we look at XLE, it's going to look the same as the oil chart. We may as well look at it. If you want to look at the equity space, it's making a jump above here. It's the highest it's been since, October 2023. So this is how we've got to start looking at things here. We've got to start thinking, okay, well, oil seems to be wanting to get its giddy up on. Oil seems to want to be increasing, and the momentum has been there since, mid-Feb, I guess. We could even say earlier, mid-Jan. So we've got a little bit of a spring here too. But the fact that, the likes of Bank of America are agreeing with this viewpoint suggests to me that maybe the inflation story isn't necessarily done yet. The one consideration here is that, what if it is some sort of fake out? Is there anything that could, mean that oil is suppressed? I guess OPEC have cut supply further as well. That was something that I completely missed. I think that happened on Friday. So OPEC continuing to strangle supply is going to be bullish the oil price, right? Especially with demand remaining relatively constant where it is. So, I do think that there are some considerations here that inflation isn't done yet. And this would sort of weigh into the higher for longer narrative. People are talking about, cuts this year. I think we can price those out. Honestly, I really, really do. Because the way that I'm looking at the market now is equities are going up, unemployment's not really being hit. So do tell me the reason as to why the Fed would look to cut. And from a trading perspective, momentum is still with risk assets. We can see even energy picking up after being, battered for quite a while now. So, if we look at energy since, Q3, it's just gone down pretty much. It's fallen by $10. Not bad. I think that's probably an overstatement, but it's not done as well as it had been. Basically, it flattened out, right? So that is how I would look at oil. I would maybe start suggesting that inflation's not done. I'm not saying we're going to get hyperinflation, or not hyperinflation, but the same kind of inflation that we had over the pandemic. But what I am suggesting is that maybe it keeps some form of stickiness, which would keep stickiness to interest rates. But at the end of the day, if we look at it from a risk asset perspective, if we want to actually action a trade, higher interest rates have done nothing to equities. So who cares? Just look at the momentum, look at things like this. And I think when data does start slipping is when we should maybe introduce the macro more. Maybe that's when we can call for regime change, when unemployment's going. But until then, the unemployment metrics aren't shifting. Even if you don't really trust the unemployment metrics, the market has to look at those. It doesn't matter what your personal view is on the unemployment metrics or any other metric for that matter. If the market considers it good or worse, trade that. That is all that matters at the end of the day. But for me, I wouldn't be surprised if we do touch, $91 on XLE. The momentum is there. And I think that is what we really need to be focusing on. Today's trading takeout is, should you copy other people's trade ideas? And I feel quite strongly about this because my understanding of the industry and research and things like that is quite broad. I, put out trade ideas myself for my own personal service. And my view on this is that really trade ideas and any kind of trading education should be there to help you build your own process and thought process, rather than being there just to copy. Because at the end of the day, a trade idea that works for me might not work for you. We have different risk tolerances. We have different psychologies. We have different ways that we do things. We have different commitments. We have different ways in which we can be flexible or inflexible. And so what this means is that I might be able to manage a trade much better than you over certain durations, or you might be able to manage a trade much better than I can over certain durations. So the outcome is going to be completely different. What you have to do with, any kind of education service, signal service, is take the best bits out of them and try and apply them to your own process, rather than simply copying them, because just copying will never work.